Good afternoon, everyone. This is Anurag Singal, and I'm going to speak around sustainable investing as a concept to combat the risk of climate change. And what are the caveats that one must be wary of before just adopting the concept based on paper history. Now imagine Mumbai in 2059. Streets are empty during the day. People live underground to escape the deadly heat. Oxygen stations line the streets, offering those precious moments of breathable air to those who cannot afford nasal filters. This isn't just science fiction. I just saw this as the future that would be portrayed in a recent TV show. And while this might seem dramatic, the reality is that India is already ranked 7th in the world as far as climate risk is concerned. So it's time to get serious and get going as to how seriously we can combat the risk of climate change. So what's one way out? That's sustainable investing. Now imagine that you recently discovered that your mutual fund portfolio comprises of those companies that contribute to deforestation. How would you react? And then let's say you discovered that your mutual fund portfolio comprised of those companies that contribute to afforestation. How would you react? Most people will tend to act altruistic on social media, on public platforms, but when in a heart-to-heart talk, they say that when they themselves combat their home loan EMIs as a burden, they are barely agnostic between afforestation and deforestation. They just want the mutual fund manager to top up returns such that they can pay off their home loans quickly. And hence, the whole idea of your investments shape the world around you may not necessarily hold good for a vast majority of people. ESG investing therefore has a caveat that there's often a lot more lip service to the concept. When it comes to actual investing, people might really have different opinions. So the larger concept is impact investing is driven by what is the legacy that you would like to leave behind. Is it those green, dense forest or complete concrete jungles that you want for your next generation? Now, what is sustainable investing? So for those who are uninitiated in this concept, it is built around the three engines, the three pillars of E, S and G: environment, social and governance. So environment would broadly, let's say, measure your carbon footprint, your affirmation action towards afforestation, etc. Social is those initiatives that you take for society at large, for example, education for the underprivileged, health, and then governance. For example, how actively is your board managed? How well do you treat your employees, your stakeholders, women representation as independent directors on your board? These are the kind of ideas that will govern your ESG rankings. Now, why are ESG rankings important? Because $30 trillion around the world gets infused into companies only on the basis of their ESG rankings. Just look at this. Google searches around ESG have witnessed a sharp rise over the last decade. They've become 10x. And similarly, ESG mutual funds have now seen $30 trillion of assets under management, and by 2030 that's likely to become $40 trillion, all driven by the three pillars of E, S and G. But then there are larger intricacies to this whole concept which we are going to now talk about. So in India, for example, there are a host of funds which are themed around ESG investing, and the top companies here are HDFC Bank, which is included in 8 out of those 9 funds with a AUM of 830 crores, ICICI Bank in 7 of those 9 funds with 789 crores, Infosys in 5 on 9 of those funds with 700 plus crores, And then Bharti Airtel, telecom, as a sector, 4 on 9 of the companies, 220 crores. So that's how there are these rating companies like Sustainalytics, which rate the companies based on their ESG footprint and rates them as low risk, medium risk, etc. And hence the larger fund flows go into these companies. But there is this illusion of good investments. Why do sectors like telecom and then financial services and technology attract investments? Because they appear very clean on paper. They've got very little carbon footprint. However, this narrow view largely overlooks the broader carbon ramifications that these companies have. For example, the intensity of energy that is guzzled by a data center powering these AI initiatives, sprawling supply chains, and the environmental toll of manufacturing capabilities. By rewarding companies in this domain like technology, telecom and financial services, you actually increase the cost of borrowing for manufacturing companies where actually you need the affirmative action in terms of ESG funds, because that's where you really need to do a lot for the E, but that's not happening. Take the case of Bharti Airtel, for example. It's a very clean company, one of the most highly ranked ESG companies in the country, but then it has got lakhs of mobile data towers that run on diesel. And then it has got extensive data center operations, which significantly contribute to GHG emissions, that is greenhouse gases emissions. But ESG frameworks, they often reward perception rather than performance. Companies which write very beautifully on their reports, sign MOUs and take action which signals to the world their commitment towards ESG are taken very seriously by the investor community, and hence the inclusion in almost all the funds. So one way out is that investors should look not just at scope 1 level emissions, which are the direct emissions from your operations, and scope 2, which are the indirect emissions from the purchased energy, but even scope 3 emissions, which include the broader environmental impact of your supply chain, your investments, your partnerships. This is particularly important because companies are now expanding their AI capabilities, which demands immense computational power and energy resources. So scope 1, scope 2 and scope 3, one should look at holistically your entire footprint. In many cases, the fact of the matter is that ESG has become a branding tool rather than as a catalyst for meaningful change. Imagine the legendary Warren Buffett of Berkshire Hathaway does not believe in ESG investments. He feels that it's just a farce. And so is Donald Trump, which we are going to cover later. Now think about it. ExxonMobil as a company finds inclusion in the sustainable indexes, but Tesla has been kicked out. And there is a tweet by Elon Musk which condemns the entire authenticity of these ESG ratings. He says Tesla faces criticism over workplace issues. ExxonMobil scored better on just certain governance standards, notwithstanding that this company has actually contributed to the largest oil spillover in the history of United States. So there is this fundamental flaw in ESG ratings. They prioritize those surface level aspects rather than the transformative impact. An oil company scores higher on the rankings than a company which has literally transformed the world in terms of electric vehicles. So is it really something that should be taken seriously, or is it just a numbers game? That's one question that needs to be seriously considered. In India, take for example, there's a Nifty ESG fund. The index has been outperformed by companies such as Godrej Philip, which is into cigarettes, Bharat Dynamics Limited, which makes missiles and ammunition, Bharat Earth Moving Limited, BEML, which makes mining machinery, and then United Spirits, which is into alcohol. And the ESG index is fairly underperforming when it comes to these larger poster boys of success. So imagine the pressure on a fund manager who takes all your money, has to justify the fund management fee, has to generate alpha, and faces the reality that ESG investing is going to underperform the larger play of non-ESG players. So that's where the challenge comes. The ESG label has actually confused people ever since it was coined. Imagine the biggest holdings of ESG funds globally are tech and finance stocks. Case in point, Nvidia. 70% of ESG funds globally hold this particular company, 3,600 plus ESG funds. And these companies are developing AI that guzzles electricity, they guzzle power. And Morningstar has estimated that Nvidia is emitting greenhouse gases at a pace that brings global warming by 3.8%, more than the twice the critical threshold of 1.5% a degree Celsius. So that's the intensity to which the operations of an Nvidia is disturbing the carbon footprint of the world. Think of it, the largest oil and gas company in the US, ExxonMobil, is held by more than 1,000 ESG funds. Glencore, which is the global leader in terms of trading of commodities, coal, metals, etc., is held by more than 400 ESG funds. And most importantly, Rheinmetall, 550 ESG funds hold Germany's largest military equipment maker. According to Capital Monitor's analysis, 52% of sustainable funds hold 7.3 billion in terms of military weapons as an asset class alone. ESG investing and these concepts. Somehow we've manufactured a logic to justify that E gets overshadowed by S and G. That is, a company which may be not necessarily active to positively contribute on the environmental front does so much on the society and the governance front that their overall rankings justify their inclusion in these indexes. ESG funds screen out many sin stocks, but the average exposure to fossil fuels, military weapons, nuclear weapons and tobacco producers is fairly high, and that's what data tells you. What surprised me was also the fact that British American Tobacco, one of the world's largest tobacco companies manufacturing cigarettes, finds an ESG corporate rating letter grade that hails the company in terms of governance standards. Now remember, it is this company which contributes to cigarettes, which takes 8 million deaths globally. 7 million people die out of direct smoking and just 1.2 million people die because of the passive impacts of smoking. And still, such companies are celebrated as champions of governance and find inclusion in the ESG index. Another caveat is the whole concept of greenwashing. Many companies sell their concepts by spreading fake messages that they deploy eco-friendly products. They are engaged into environmental friendly practices. But when probed deeply beyond the surface, a lot of these claims are not true. Volkswagen, for example, admitted that it was cheating emission test by programming the device to report lower emission levels when they were being reported for ESG test. Now that could be really shocking, but a company of Volkswagen stature has admitted to doing that. H&M, fast fashion, 96% of the claims that they made on the sustainability front did not hold true when they were actually tested. That's the extent to which these large companies resort to greenwashing just to emerge high on the rankings. 60% of overall claims of fast fashion companies contributed to misleading advertisements. Now, fast fashion is actually another sector which contributes immensely to carbon footprint, given these are just very fast moving items which are very inefficient supply chain. You just buy a dress, wear it once or twice and just dispose it off, notwithstanding the entire disaster it creates in terms of carbon footprint for the world at large. Now Trump being back in office can actually impact sustainable investing big time. You're already seeing some sort of an outflow from ESG funds because of this entire political drama, because the president of the world's most powerful country does not subscribe to this concept of environment. He says he's going to withdraw from the Paris Agreement, he's going to roll back greenhouse regulations and increase support for the oil and coal sectors, and he's going to decrease the ESG disclosure requirements. Imagine the catastrophe this is going to result in for the concept of sustainable investing. But Trump being Trump, whatever he says, he executes. Now think of the mammoth influence this is going to have to this world, the future that we were supposed to give to our generations. But not all gloom. Does this mean that we should stop sustainable investing? No. We should invest in a small number of carefully selected companies. Take a targeted approach and invest in those categories that you believe is poised to take the world to the next level of growth. For example, a company like Antony Waste. It is going to take up the projects for municipal waste disposal in cities across the country. If these kind of companies get the attention of ESG funds, get included and therefore get the flows, a lot more affirmative action will be taken for this entire concept of sustainability. So the challenge is, how do we shift from buzzwords to meaningful action? First of all, we need to talk about data transparency, about standardization, that how about E, S and G? What is the weighted attached to the three different letters? Can a company which seriously pollutes the world at large do so much on the governance and the social front that it becomes pavitra, as they say? So do we have uniform ESG standards across the world? Would regulators really enforce accountability in terms of benchmarking against the right matrices? And then impact focused investing, not just lip service, not just branding, but actually rewarding those sectors which contribute to the world's sustainability. So impact focused investing, prioritizing those funds which address environment and social concerns. And then education and advocacy in terms of consumers and investors asking whether this company is truly sustainable or is it just a lot of paper driven reports, clever branding, some active corporate communications driving strategies that make these companies move up the rankings.